Welcome to today's webinar. Today's preview is specifically for partners and LLCs taxed as a partnership. So consultants, real estate partners, professional practices, and anyone who receives a Schedule K-1 where they report self-employment income. If that's you, you are going to want to lean in. So as always, this is your chance to get answers. Use the chat to ask questions on today's topic or anything else for that matter, whether other aspects about solo 401k plans and even self-directed IRAs. Type them over now so that we'll be sure to get to them all. Let's continue here. So before determining whether or not you need to open a solo 401k plan by December 31st of tax year 2025, so that you can utilize the Mega Backdoor Roth strategy for those who are self-employed as a partnership, you need to make sure that you're eligible to open a solo 401k plan. So you need to have earned income from self-employment activity in order to be considered self-employed. You also cannot employ any non-owner W-2 employees who work 1,000 hours or more in your business unless those individuals are under age 21, because you can always exclude anyone who's under age 21, regardless of how many hours they work as a W-2 employee, from participating in a 401k plan, even including a solo 401k plan. You can also exclude contractors. So today's webinar is we're honing in on the Mega Backdoor Roth for a partnership. So in the context of being self-employed, it could be an LLC tax as a partnership, or it could just be a straight up partnership where you file Form 1065. You're going to want to make sure that you are doing material services, not investment type of services, but material services, and you're going to report that self-employment activity on your Schedule K-1. There's a line number on that Schedule K-1 that's titled self-employment income. We'll talk about that more in a little bit. But you need to make sure you're doing self-employment activity in order to open a solo 401k plan, because again, a solo 401k plan is for owner-only businesses. Your spouse can also work in your business. He or she doesn't have to be an owner in the business, as long as he or she is also doing self-employment activity under that partnership. Then you can both participate in the same business and therefore the same solo 401k plan. It would result in just one solo 401k plan for both spouses. So why does the Mega Backdoor Roth Form 1065 deadline for tax year 2025 matter for those who are in a partnership? And just as a little background, we did a couple webinars last week on the Mega Backdoor Roth deadline for tax year 2025 for a business tax as an S corporation, as well as a sole proprietorship. So this is part of that series. Today we're honing in on partnerships. You can visit our webinar list on our YouTube channel. So if you subscribe to our channel, you get access to those webinars, including over 1,000 other webinars. So today we're honing in on the partnership one. So why does this matter? Well, because a lot of individuals are utilizing the Mega Backdoor Roth strategy, which is a way to get more Roth funds into your solo 401k plan above the typical annual employee and employer contribution limits. So partnerships, so businesses taxed as a partnership, they have a stricter deadline than a sole proprietorship with regards to setting up solo 401k plans for the year. Now, that strict setup of setting up the plan by December 31st of tax year 2025 in this particular case has to do with making employee contributions. So if you want to make employee contributions through your solo 401k plan based on your self-employed business that's taxed as a partnership, you need to make sure that you set up the plan by December 31st of 2025. And that means you need to simply sign the plan documents. Signing the plan documents means that the plan is effective and you've met the December 31st tax year 2025 deadline. So it's not when you open the bank or brokerage accounts, aka the holding accounts for the solo 401k. It's rather when you sign the documents. If you sign those documents by December 31st of 2025, you're going to be able to wait till 2026 to both open the bank or brokerage accounts for the solo 401k, obtain the employer identification number for the solo 401k, and make the contributions. For a partnership, contributions would be due by March 15 of 2026 if you want to contribute for tax year 2025. If you file for a partnership tax return extension, so a Form 1065 extension, you are going to have an extra 6 months. You would have until September 15 of 2026 to make contributions for tax year 2025 to that solo 401k plan. So, in short, if you want to preserve the right to make employee contributions, which means the $23,500 contribution limit for tax year 2025, if you want to preserve that right to make those contributions in 2026 by your business tax return due date plus time you file extension, you need to sign the plan documents by December 31st. That's simple. If you wait till January 1st of 2026 and after, you're not going to be able to make any employee contributions. However, you are going to be able to make both employer contributions and voluntary after-tax solo 401k contributions. The voluntary after-tax solo 401k contributions is part of the Mega Backdoor Roth strategy. So the only deadline you really need to worry about here in December of tax year 2025 is the employee contribution deadline. So for those who listen to this webinar, which is recorded, if they listen to it in 2026, it's good to know that if you miss the December 31st setup deadline for making employee contributions, you did not miss the deadline for making employer contributions and voluntary after-tax solo 401k contributions, because you have until March 15 or September 15 of 2026 to both adopt the plan and make the contributions for tax year 2025. Of course, if you're listening to this webinar live here in 2025 and today's December 1st, you still have the entire month of December to set up the plan, so you don't have to worry about missing the deadline for making employee contributions. So why procrastinate? Might as well get the plan opened up now. If you utilize a company like my solo 401k financial, we make it easy. We provide those plan documents, which are the legal plan documents, the same day. All you have to do is sign those documents, and then you can wait, relax, enjoy your holidays while we're working hard over here. Enjoy your holidays and open up the bank brokerage accounts next year in 2026 by your business tax return due date plus timely filed extension, so that you can make contributions, all contribution types, employee, employer, and voluntary after tax for 2025 and 2026. So again, if you miss the December 31st deadline, it only eliminates being able to make employee, also known as salary deferral contributions. It does not eliminate your option to make employer and voluntary after-tax solo 401k contributions, even if you open the plan after January 1st of 2026. You're still going to be able to make contributions, both employer and voluntary after-tax in 2026 for 2025, as long as you do it by March 15, or if you file for an extension by September 15 of 2026. It's that simple. And of course, the Mega Backdoor Roth strategy is not available in all solo 401k plans. Off-the-shelf solo 401k plans like the ones offered by Fidelity, Schwab, T. Rowe Price, even Ascensus, even by big banks, Chase, Wells Fargo, those don't allow for voluntary after-tax solo 401k contributions which is part of the Mega Backdoor Roth strategy. You have to have a plan that allows for, number one, being able to make voluntary after-tax solo 401k contributions. Number two, separate accounting within the plan to isolate those voluntary after-tax solo 401k funds so that the pro rata rule that applies to backdoor Roth IRAs doesn't spill over into the mega backdoor Roth. And third, that allows for converting voluntary after-tax solo 401k contributions to the Roth solo 401k or the Roth IRA. That's how it works. So here at my solo 401k financial, we offer such a plan. Our plan comes with all the bells and whistles. We draft the plan documents for the maximum flexibility under the regulations, which means that you don't have to take advantage of all the bells and whistles. What are some of those bells and whistles? Being able to do the mega backdoor Roth strategy, being able to take a solo 401k participant loan, being able to invest not only in equities, but those alternative investments like private placements, physical real estate like rental properties, whether it's commercial, residential, farmland, cryptocurrency, tax liens, promissory notes, viaticals, the list goes on and on. And we're well versed on the regulations of all the bells and whistles that come with a plan. So let's take a look at some questions here. We'll pick back up where we left off. So we got a question here. I'm a financial advisor and looking to get a plan document created and ongoing compliance for a new client that I think would benefit from a solo 401k plan. How does this work if I'm going to hold the account as my own custodian and only want the plan document and ongoing compliance for the plan? Excellent question. The majority of our business is on the institutional side, which means that most of our business comes to us from financial advisors, as well as other professionals, whether it's CPAs or attorneys. So here at my solo 401k financial, you, as the financial advisor in coordination with your client, get to choose where to hold the money at. Obviously, you're probably going to hold it at the custodian that you clear through, whether that's LPL, whether that's Schwab, whether that's Fidelity, whether that's Altruist, whoever you're clear with, you get to choose where to hold the funds at. So at my solo 401k financial, we don't take deposits. We're not a depository taking institution. We do what we do best, and that is provide a solo 401k plan. So we serve as the plan provider, hence why our annual fee is only $125. We also take care of other compliance reporting for the plan at no additional cost, such as filing Form 5500 Easy, which is an informational return that applies to the solo 401k plan. Once the market value of that solo 401k plan exceeds 250,000 in market value as at the end of the plan year. For example, if the solo 401k plan is greater than 250,000 in value as of December 31st of 2025, a Form 5500 Easy is going to need to be filed with the government, so the IRS, by July 31st of next year in 2026. We'll prepare and file that at no additional cost as long as it's timely requested. We don't have access to our clients' funds, so it's a financial advisor along with their client's responsibility to communicate to us when that threshold is reached so that we can perform that reporting. So not only are we the plan document provider, but we also are the compliance provider. A lot of times your clients might ask to identify what's our role. What's my solo 401k financials role if you're my financial advisor? Well, the best way to explain that is that my solo 401k financial is the plan document provider for the plan, number one. And number two, they'll provide ongoing compliance support as long as you timely request it, such as filing Form 5500 Easy, so both preparing it and filing it. Also, Form 1099-R, we'll prepare and file that as well, as long as they're timely requested. The Form 1099-R, it's used to report distributions, conversions, whether the mega backdoor Roth conversion or pre-tax solo 401k conversions or a plan termination. So as an advisor, when you complete our online application, you're going to want to list on there that you are the advisor on the account. You'll do that by listing your name and your email address on the very last question of that open account questionnaire. And that's how we know that, hey, this is this particular advisor's client. So now we know what we need to do, which means that we need to copy the advisor and the client going forward, including asking the client to make payment of our fee. And we'll copy you through the entire process and also going forward in all communications with the client. What is more, depending on who you clear with, who your broker dealer is, we'll prepare the brokerage forms as part of the setup process so that you can submit them through your back channel. We'll also obtain the employer identification number for the plan. The 401k is a retirement trust, so it needs its own separate employer identification number. You do not use the EIN for the business. That EIN for the solo 401k plan, remember, a solo 401k plan is a retirement trust. So it's a separate legal entity. That form, that EIN for the plan, that also needs to be listed on a Form 1099-R when we report the mega backdoor Roth conversion or any type of distribution from the plan, including required minimum distributions, hardship distributions, and so forth. So a good question. Okay. Again, go ahead and type over your questions. They don't have to be surrounding today's topic, and we'll go ahead and continue to answer those questions as they come in. In the meantime, let's continue with today's topic, which is the mega backdoor Roth for Form 1065 partnerships. So, summary of 2025 deadlines for partnerships, LLCs, tax as a partnership. So, action. We talked about this already, but it doesn't hurt to go over it some more. So, if you want to preserve the right to make employee contributions to the solo 401 plan for tax year 2025, you need to adopt the solo 401k plan by December 31st of 2025. Adopting the plan simply means signing the plan documents. As soon as you sign the plan documents, the plan's effective. And of course, by signing the plan documents by December 31st of 2025, not only are you going to be able to make employee contributions in 2025 or in 2026, but you can also make employer contributions and voluntary after-tax solo 401k contributions. If you adopt the plan in 2026, so January 1st, 2026 and after, then you're not going to be able to make employee contributions, but you are going to be able to make both employer contributions, also known as profit sharing contributions, as well as voluntary after-tax solo 401k contributions as part of the mega backdoor Roth. You want to make sure you do that by March 15 of 2026 or by September 15 of 2026 if you file a timely Form 1065 business tax return extension. Again, we're talking about partnerships. We're not talking about sole proprietorships or S corps. We already talked about those last week in separate webinars. You can learn more about the partnership deadline by visiting the link right here at the bottom of this slide. How the mega backdoor Roth works for partnerships. Well, as I touched on earlier, you have to make sure you open a plan with the company that offers solo 401k plans that provides a plan that allows for voluntary after-tax solo 401k contributions. Such a provider is my solo 401k financial. Just like all contribution types, employee, employer, voluntary after-tax solo 401k contributions for a partnership are determined first by looking at K1, your schedule K1, line 14 with the code A. That's going to be the starting figure for calculating voluntary after-tax solo 401k contributions if your business is taxed as a partnership. Now, this is why earned income matters. We're going full circle here, where we talked about in order to open a solo 401k, you have to be self-employed and you have to be performing material services. You got to be doing the work. It cannot be investment income, capital gains income. It's got to be earned income. And that earned income is determined based on how your self-employed business is taxed. If it's a sole proprietorship, you're going to have to look at line 31 of your Schedule C for making contributions to determine the amount of income you have, and that determines how much you can contribute to the plan. For an S corporation, it's going to be box 1 of your W-2. For a partnership, is line 14, code A of the Schedule K-1. So here we have it. Here's a good slide here. If your business is taxed as a partnership, you're going to want to look at your Form 1065. That line, it's titled self-employment income. It's not based on passive income, it's based on earned income. That Form 1065 has a line number, which is line 14 with the code A. It's titled self-employment income. Once you know that line 31 of that Schedule K-1, then you have to subtract 1/2 of self-employment income tax from that line number. With our calculator will subtract that 1/2 of self-employment income tax from that line 14A of Schedule K-1 for you. So here's an example of the voluntary after-tax contribution as part of the Mega Backdoor Roth for a self-employed business tax of the partnership. So this is where the Mega Backdoor Roth magic comes in. You can contribute 100% of your self-employment income minus employee and employer contributions. So that means that if you're also making employee and employer contributions to your solo 401k plan, that's going to reduce the amount of voluntary after-tax solo 401k contributions you can make to the plan. But some clients skip making employee and employer contributions and solely make voluntary after-tax solo 401k contributions because they want to utilize the Mega Backdoor Roth strategy. They want to maximize it. Sometimes you'll hear clients out there asking, can I perform the Mega Backdoor Roth in my solo IRA? I end up scratching my head, but what they really mean is solo 401k. For some reason, individuals out there like to refer to a solo 401k as a solo IRA. Well, number one, a 401k is not an IRA. A 401k is a retirement plan for employers, whereas an IRA is an individual retirement arrangement for individuals. You don't have to be self-employed to have an IRA. And then they confuse that you can do a backdoor Roth IRA, so they start talking about solo IRAs when they're really talking about the backdoor Roth IRA. So just make note of that out there. If you hear the word someone say solo IRA, they're really saying solo 401k. So as far as calculating the magic number for a business tax of the partnership for maximizing the Roth solo 401k contributions, because remember, making voluntary after-tax solo 401k contributions as part of the Mega Backdoor Roth is a way to indirectly get more Roth funds into your solo 401k. So here's an example here. If you look at this graph here, let me get back to that chart here. Give me a moment here. So if you look at this, so here we go. Someone who's under age 50, the maximum Schedule K-1 line 14 with the code A self-employment income that you're going to need is $75,322. So that's the maximum Schedule K-1 line 14 self-employment income you're going to need for tax year 2025 if your goal is to maximize the overall contribution to the solo 401k plan, which is $70,000 for tax year 2025 for someone who's under age 50. And then what you can do is you can say, well, I'm going to treat that entire $70,000 as a voluntary after-tax solo 401k contribution. So you could contribute that entire amount to the voluntary after-tax solo 401k bucket. So let me pull up that bucket here. So this bucket right here, labeled after tax, you can contribute that entire 70,000 into that bucket and then turn around and convert that to the Roth solo 401k or even to a Roth IRA. You get to choose. So this is an example of a one participant plan. So here's an example of a two participant plan. For example, both spouses are self-employed in the same business. Under either scenario, it's still considered just one solo 401k plan. However, you're going to need to have separate bank or brokerage accounts known as holding accounts under the solo 401k plan because the IRS regulations require that you separately track the three contribution types allowed in a solo 401k. That's pre-tax solo 401k contributions, whether employee or employer. That's Roth solo 401k contributions. So that's the second bucket, whether employer or employee Roth solo 401k contributions. And then the third bucket, the voluntary after-tax solo 401k bucket as part of the mega backdoor Roth. So this slide here is an example of a one participant plan. If it's a two participant plan, that's going to be a total of 6 separate bank or brokerage accounts, aka holding accounts under the solo 401k, 3 for each spouse for a total of 6, because you have to segregate each participant's funds, because a 401k is not a defined benefit plan, it's a defined contribution plan. And therefore it requires separate tracking for each employee / participant's funds. Now, even though the plan allows for all these contribution types, whether you make any of these contributions, that doesn't mean that you're going to lose the ability to make those contributions. What is more, you don't have to open up all these brokerage accounts if you're not going to make all these different contribution types. For example, if your goal is to simply make voluntary after-tax solo 401k contributions, and then you want to convert those to the Roth solo 401k, you're going to need at least 2 separate brokerage accounts. One for the voluntary after-tax solo 401k contribution, the second one for the Roth solo 401k funds, which is where you would convert those funds into. If it's a 2 participant plan, you would need a total of 4 brokerage accounts, 1 Roth for each spouse and 1 voluntary after-tax for each spouse, so they can do the conversion. On the other hand, if you're going to convert that voluntary after-tax solo 401k contribution to a Roth IRA instead of the Roth solo 401k, you only need 1 brokerage account for each spouse. So 1 brokerage account for the voluntary after-tax contributions if it's just 1 participant in the plan, 2 separate brokerage accounts. If there are 2 participants, for example, both spouses, they would each have their own separate voluntary after-tax solo 401k holding account. And if you convert it to the Roth IRA, you're going to want to make sure you open up a Roth IRA, or you can use an existing Roth IRA that you have already. So the mega backdoor Roth strategy allows you to convert to the Roth solo 401k or the Roth IRA. We find most clients convert to the Roth solo 401k instead of the Roth IRA, because just like a Roth IRA, Roth solo 401k plans are no longer subject to require minimum distributions, and you have Secure Act 2.0 to thank for that. Also, they like to consolidate all their funds in 1 plan. They want to be able to invest in real estate with their funds, cryptocurrency, or other alternative investments, or they want to take a loan from the plan. So it's good to know you have options. So the mega backdoor Roth strategy works by first opening a solo 401k plan with a company such as my solo 401k Financial, who offers a plan that allows for the mega backdoor Roth strategy. We then help you open up the holding accounts for the plan, whether at Fidelity, Schwab, or your local bank. You're going to have a designated account titled Voluntary After-Tax. So you make the contribution into that voluntary after-tax bucket. We'll help you calculate the contribution. That's all covered in our ongoing support. Once you make that contribution to that voluntary after-tax solo 401k bucket, it's time to convert. Move those funds from the voluntary after-tax solo 401k to the Roth solo 401k. Once you do that, then we need to issue a Form 1099-R. So you need to complete the online conversion form on our website. That's how we collect the information, because remember, we don't have access to your funds. So you need to communicate to us. So once you fill out that online conversion form, that's going to prompt us to issue a Form 1099-R to the IRS and a copy to you to report on mega backdoor Roth strategy. So that's how it works. And then all the funds will grow tax-free inside that Roth solo 401k. And lastly, make sure you have enough earned income from self-employment activity to justify the contribution, whether you make an employee contributions, employer contributions, or voluntary after-tax contributions. So back to the slide. Here's an example of someone who is age 50 through 59. You're going to need at least $83,392 of Schedule K1 Line 14A self-employment income for tax year 2025 if your goal is to maximize mega backdoor and Roth solo 401k contributions. That would allow you to make a $70,000 solo 401k contribution to the voluntary after-tax solo 401k bucket, and then convert it to the Roth solo 401k. It's worth noting that you can never make catch-up contributions, whether normal catch-up or super catch-up contributions, to your voluntary after-tax solo 401k bucket. That has to go directly into the Roth solo 401k bucket or the pre-tax solo 401k bucket. The maximum you can put to the maximum that you can contribute to the voluntary after-tax solo 401k for tax year 2025 is the overall contribution limit, which is $70,000, assuming you have the earned income to do so. So based on this $83,392, you can contribute $70,000 to the voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k. And then the catch-up amount of $7,500, you can deposit that directly into the Roth solo 401k bucket. Now you end up with $77,500 in Roth solo 401k contributions for the year, tax year 2025. Then there's the super catch-up contribution for those age 60 through 63. If you want to maximize the mega backdoor Roth along with the Roth solo 401k contributions, you're going to need to pay yourself at least $87,427 of Schedule K1 line 14 with the code A of self-employment income. And then you can contribute $70,000 to the voluntary after-tax solo 401k bucket and then convert it to the Roth solo 401k. And then you can contribute $11,250 catch-up contribution to the Roth solo 401k. So this is a good slide. Those are just some examples. You can even chop it up and put some into the pre-tax, some into the Roth, some as employee, some as employer. So the key here is to understand that you need to have enough earned income from self-employment activity from that self-employed partnership. And it's got to be earned income, not passive income. All right, let's see if we have any other questions here. Here's a question. Can you talk about the $1,500 tax credit for opening a solo 401k? I certainly can. So one, the solo 401k that we offer does come with the auto contribution credit. And this auto contribution credit really did not start being offered till January 1st of 2024. So if you're an existing client of my solo 401k financial and you open the plan with us prior to January 1st of 2024, we can add the auto contribution credit to your plan so that you can start taking advantage of this auto contribution credit starting here in 2025. So that's one of the reasons to set up the plan by December 31st of 2025 is so you can start utilizing that auto contribution credit in tax year 2025. And we're going to talk more about that in a moment. But if you're an existing client, so both existing clients and new clients qualify. Now, we can add this to your plan. Let me submit a support. You can submit a support ticket if you're an existing client to prompt this to add this to your plan. Okay. Now, clients of my solo 401k financial from January 1st of 2024 and after, we already draft the plan documents with the auto contribution credit. You have to utilize a plan that has the auto contribution credit built into it, along with the applicable schedules. Not all solo 401k providers provide a plan with auto contribution credit. So with this auto contribution credit, the cost of both opening and maintaining the solo 401k plan is practically free for years to come. It's a $1,500 auto contribution credit. And because it's a tax credit, it reduces your business taxable income on a dollar for dollar basis. So it's better than an expense for you CPAs out there that understand that type of lingo. So once that auto contribution credit has been added to your plan, you're not required to contribute to the plan. That's why it's kind of confusing that it's called the auto contribution credit. Don't confuse it with the tax credit. There are two different credits out there. There's one called the tax credit, and then there's the auto contribution credit. As a matter of fact, let me see if I can pull up a link we put together an article on the differences between the auto contribution credit and the tax credit. We had to do that because, understandably so, a lot of CPAs and tax professionals out there were confusing the auto contribution credit with the tax credit. So the tax credit does not apply to solo 401k plans, but the auto contribution credit does. Yes, I know it's confusing. That's why we have to do this link. Take a look at that link I just shared with you. We put together an article that compares the two, and we share that all the time. We have a lot of CPA clients as well, and we also have a lot of CPAs that use our services for their clients. So this is a very good link article to an article that we put together on how the auto contribution works. So let me get back to that slide here. So it's a dollar for dollar tax credit equal to $500 per year amounts. So you have to spread that $1,500 auto contribution credit over a 3-year period. So for example, if you open your solo 401k plan in 2025, or if you're an existing client and have us add that auto contribution credit to your plan, you can claim a $500 credit with your tax year 2025 taxes, which would be due next year in 2026. Then you can claim a second $500 amount for 2026 and a third and final $500 amount in 2027 for a total of $1,500. So 500 times 3 over a 3-year period. And again, you have to adopt a plan that from a provider like my solo 401k financial, who has the auto contribution built into the plan. And again, you're not required to contribute. You can act. We'll provide the forms to opt out of contributing a minimum of 3%. And even if you opt out, you're still going to be able to contribute as much as you want up to the overall limit for the year, which is $70,000 for tax year 2025 for someone who's under age 50. So it's not going to make you subject to contributing, nor are you not going to be able to contribute. So take advantage. I mean, it's the best thing that the IRS can do is provide this type of auto contribution credit to get the self-employment community to save for retirement. And you're going to use Form 8881. That's the form you use to claim that credit. And you're going to attach that to your Form 1065 if your business is taxed as a partnership. Of course, if your business is a sole proprietorship, you still qualify. If it's an S corporation, you still qualify. All self-employed businesses qualify. Now, Form 8881, we have a walkthrough on that, a PowerPoint, and a video. It's very easy to fill out. You attach it to your business tax return. So you're going to file that Form 8881 a total of 3 times, once each year for 3 consecutive years to claim that $500 credit. Hopefully that sheds light for you on that question you have there. Okay, let's see here. Is there someone that can walk me through the initial application to ensure I complete it correctly? It's a very easy form to fill out. Even someone who's never heard of a solo 401 can fill it out. We ask for very basic information such as your name, your address, phone number, the name of your business, and that's it. So go ahead and give it a shot. If the application is not completed correctly, which I've only seen it happen maybe once out of a million times, then we'll make sure to identify it. All right, let's see here if we have any other questions for now. All right, so go ahead and continue chatting over your questions, and we'll be happy to go over them. Doesn't have to be about today's topic specifically. If this information is helping you feel confident about your future, please take 1 second to like and subscribe. It tells the platform this information is valuable, which helps other solopreneurs like you and partnerships like you to find it. Subscribing also guarantees that you receive information of all the crucial content that we deliver every day to help you secure your retirement. All right, let's keep going here through our topic from today. So let's get back to my slides here. All right, let's continue talking about today's topic. So Roth strategy. So partners often, so again, we're talking about a partnership. We've done other webinars about S corporations and sole proprietorships. Today, we're honing in on the mega backdoor Roth strategy for a business tax as a partnership. So if you want to solely utilize the the mega backdoor Roth strategy, you can solely make voluntary after-tax solo 401k contributions. You just need to identify line 14A, code A of your Form 1065 Schedule 1, and then subtract 1/2 of self-employment income tax from that figure. And then the difference, you can contribute it all as a voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k or the Roth IRA. So talk about really supercharging your retirement account savings. So key takeaways. The magic number of partnership income needed to max out your solo 401k depends on your age and your contribution strategy. Because with the voluntary after-tax solo 401k contributions, it's a dollar for dollar calculation. That means it takes less self-employment income to get to that overall contribution limit of $70,000 when you compare it to employer profit sharing contributions. That's a percentage calculation. That's where you multiply 1/2 of the Schedule K1 line 14 code A. After you subtract 1/2 of self-employment income tax, you would multiply that times 20% for employer contributions. So it's going to take more line 14 code A Schedule K1 self-employment income in order to maximize employer contributions because it's a percentage calculation. Well, the voluntary after-tax solo 401k contribution is a dollar for dollar calculation. It's not a percentage calculation. So you need a lot less self-employment income to utilize that mega backdoor Roth strategy up to the overall limit of $70,000 for tax year 2025. We talked about how for partnerships, you need to use self-employment income, which is calculated using line 14 of your Schedule K1. I think I beat that horse to death already. I've already talked about that enough. So, and then you've got the age-based catch-up contributions. You got the normal catch-up, super catch-up contributions. We talked about how voluntary after-tax contributions offer more flexibility than employer Roth contributions because those are a percentage-based calculation. You can learn more by visiting that link right there. All right. So next steps is if you want to set up the plan by December 31st of 2025, you still have time. If you listen to this webinar after January 1st of 2026 or on January 1st, 2026 and after, you only have time to make employer and voluntary after-tax solo 401k contributions unless you open your plan by December 31st of 2025, which would allow you to also make employee contributions. So we provide compliance support and we help you get everything set up here at my solo 401k. Let's take a look at some more questions here. I saw it asked for the name of the plan. Is that just the business name? You can use any name you want. You can use a fictitious name or you can use the business name. You just want to make sure it's got 3 words. For example, if your business name is called Christmas Trees LLC, you can name the plan Christmas Trees Trust. If you're a sole proprietorship and you're doing business under your name, you can use a fictitious name, such as Pine Trees Trust. All right. Looks like we've come to the end of our webinar today. So that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your future depends on it. If you haven't yet, please like and subscribe so that we can keep building this community. We'll be back here in a couple more hours with more crucial content. Until then, have a good rest of the day.